Hello. Certainly isn't sunny here. Okay, fine. Right. Now, here we go. Right. Welcome to my latest webinar with me, Rich Perry, market analyst at Handtech Markets. I'm going to talk about chart patterns this week. I think chart patterns are an incredibly interesting topic and sort of is a follow-on to what I spoke about a couple of weeks ago, which was single period chart patterns. But now we're going to talk about multiple period chart patterns. We're going to sort of introduce double tops, head and shoulders, flags, triangles, etc. So it's going to get there's quite a lot of material for me to get through. So hopefully you will be able to follow it okay. But as per usual, any sort of questions or anything, just give me a shout. I will try and cover them as well as I can, and any questions that I don't cover, please feel free to email me at the end. As ever, risk warning, because I'm going to be talking about live market information, so please read that. I will show it again at the end, just in case, but that should hopefully cover everything. I'm not going to dwell on too much on my biog, because I'm hoping that you've seen it all before, and it's all quite boring anyway, so... Right, straight into it really. There's a lot to get through, so we're going to talk about pattern theory. Basically, trade what you see, don't sort of hope that you see a pattern, only trade when you do actually see a pattern. Also concepts such as waiting for pullbacks before you can get into trades, etc., etc. I'm going to look at reversal patterns, continuation patterns, which are the main two types of chart patterns that you get, and then towards the end I'm going to be looking at live market analysis. So going to bring in a load of indicators that I'm hoping that if anyone has been in any of my webinars previously, you would understand. And as I said at the beginning, any sort of questions you want me to look at, any markets or anything that I haven't covered that you'd like me to cover, then please give me a shout. So that is that. Right, okay. Now, chart patterns. In terms of pattern analysis, technical analysis actually involves charts depicting the basis of support and resistance. And sort of when you get these trends and trend lines or supports and resistances being breached, that's when you get a recognizable chart pattern that you can trade off. Now, you can identify these chart patterns, and they do run off quite predictable courses that you can then help to derive potential future price movements. Now, pattern analysis is an art form. It's not necessarily a science. This is why it's quite difficult, say, for example, for the trading systems, for the algos to pick them up, because basically chart patterns are, to all intents and purposes, different traders would see different patterns. So it's all beauty is in the eye of the beholder, effectively. So one of the best tips, as I said, for you is that don't trade what isn't there. So trade what you can see. Basically, I was taught by one of my technical analysis mentors, and he was always drumming it into me that if it doesn't hit you between the eyes, then don't trade it. Basically, because it's not it sort of reduces the effectiveness of the pattern and the probability that the pattern is actually going to work. So you get it's easier for the trade not to come through as you had predicted. Now, the good thing about pattern analysis is that you can use it across a whole range of timescales. So from anything from 5 minutes up to sort of monthly analysis, you can use patterns, and you can identify them across the board. As I said, there are two different types. You've got reversal patterns, which are sort of like your head and shoulders, your double tops, your multiple tops and multiple bases. And then you've got your continuation patterns, where you look at the likes of flags, triangles, and range breakouts. Now, sort of your reversal patterns will be reversing and sort of signaling the end of a prevailing trend, whilst the continuation patterns are a sort of mid-range pattern, and they will signal your continuation of that prevailing trend. Right, so your first reversal pattern is your head and shoulders top. I think everyone's probably heard about this. Pretty much anyone who's looked at markets will probably have heard of head and shoulders patterns, and it sort of is a situation where you get an uptrend, a strong trend, and you start to get the breakdown of that trend, and you then get a test of the support, and then subsequently the support is broken to the downside, and you get effectively a head and shoulders top, where you get a small top followed by a larger top, and then you get a lower right hand shoulder, which is your lower high, your key lower high, and that is in your top patterns. It's basically classic Dow theory. Dow theory is big topic of subject, but it is one of the basic tenets of technical analysis, whereby uptrends are, trend analysis is key. Trend analysis should follow the pattern of a succession of higher highs and higher lows, but when that sequence of higher lows is breached, then you start to get the breakdown of that trend, and you get your reversal patterns, and hence your head and shoulders top. The the opposite of that is head and shoulders bottom, which is in a downtrend, and it signals the end of the downtrend. Very similar, actually, is double tops and bottoms, without the whole concept of your larger top. It sort of has the immediate breakdown of the key support. Your first key reaction low gets broken down, and then you subsequently have a trend reversal and a move to the downside on your top, and the opposite being in case on the bottom. Now, what I'm going to do is, this is all a bit of theory, and I'm going to show you in practice in a little bit on the charts. In fact, why not I show you a couple of charts now? Actually, sorry, no, before I do that, a couple of things I wanted to discuss very briefly was, first of all, the big question is, should you get worked up about what you actually call your patterns? I believe no, in the fact that basically all your sort of reversal patterns will give you pretty much the same target. Say, for example, basically you measure from the neckline to the top, and then project that downwards on your top patterns, and basically you can derive that from both your head and shoulders tops, which is your neckline to the peak, measured projected downwards. Similar pattern with your double tops as well. So there is no real reason to get too worked up about exactly what you call your reversal patterns. There's another concept also within patterns is in terms of pullbacks. Now, sort of the key to understanding support and resistance is that old resistance becomes new support, and old support becomes new resistance. So you sort of get the flip of once you've got a level that's broken, that actually becomes your new level of resistance. Say, for example, if you've got a support that's in place and that gets broken to the downside, that will now subsequently become your resistance, because anyone who's bought in at that support, who's subsequently been broken, if they see a pullback towards that support, they will use that as an opportunity to sort of close that position for flat. That hence why you often will get pullbacks, and I'll show you quite a few pullbacks in my chart examples that I'm going to show you in a minute. Right, so a few examples. Okay, this is a head and shoulders top that I found on sterling, actually a weekly chart. So again, this just shows you that you do get patterns. You got your left hand shoulder there with one test, one low. You've got a sequence of higher lows here, but then you suddenly get the breakdown of that high low, and you get a retest of that support, which actually holds initially, but then subsequently gets broken to the downside. So on that downside break, you can then start to measure the peak to the neckline and then project that downwards, and you get your target at $1.76 figure there or thereabouts. So that's your head and shoulders top. Similar to that, you've got your head and shoulders reversal, where you've got your prevailing trend in place. You start to then you've got your reaction, your lower reaction high there, which is fine. And then suddenly you start to get a test of that, and this is actually a horizontal neckline. That previous one was not actually completely horizontal, but this is a pretty good example actually. So you get your test of that resistance comes in and actually holds first of all, but then starts to break down, or break higher, sorry. and on the break, you start to see the completion of that head and shoulders reversal, one shoulder, one head, and your second shoulder. And then you project higher from the neckline to the, from your head to the neckline, and then project that upwards. And you get a target of 164.75 on sterling yen, which only just missed its target. In fact, if I run this on, it didn't actually quite hit it. Now, the other thing I was going to say was the implied targets. Now, you need to make sure that you know exactly what your overriding trend is, or what your prevailing trend is, because it will ascertain exactly what your how your attitude towards your targets are. If you're sitting in a big long-term downtrend and you see a reversal within that downtrend, unless it's a major trend reversal, if it's like a secondary trend or a tertiary trend reversal within that downtrend, then you need to understand that bear market rallies will often tend to undershoot their targets. So you'll often see, for example, in this example here, you had this reversal and it did work for a while, but it didn't quite meet the target, and that is because you've got an overriding bear trend in play here, and that subsequently paid to the rally going on for too long, and that is a concept that you need to also be aware of. Small print on charts. I have to apologise for that. I've got some bigger print that does come through in a bit, but yeah, sorry about that. Okay, there's not a lot I can do about that now. And also, look for confirmation as well in your patterns. Confirmation is is probably my favourite word in technical analysis. I love confirmation. I don't like to trade off just off a whim. I like to have ideally multiple indicators confirming, but in terms of pattern analysis, your confirmation will often come with a retest of your levels, of your breakout level. So in this case, your neckline gets retested a couple of times, actually 3 times, and then you get this continuation of the higher lows. So that is sort of confirming that you're getting a turnaround in this outlook. And you get to move higher. Also, you can look for your momentum indicators. I know momentum is not really involved in pattern analysis because patterns is all about price, and momentum isn't necessarily specifically about, well, I mean, it is about price, but not in this regard. You can also look for confirmation moves on your momentum indicators as well. So if you've got a head and shoulders reversal, say, for example, or a double top, double bottom, you want to see your momentum indicators also breaking out above those reaction highs as well. So you want to see confirmation ideally on your momentum indicators as well. Okay, so here is the example of a double top again, and this is on Eurodollar recently, actually April 2014. So we had a lovely double top here that broke down below your neckline that comes in around $1.3670. Again, you get 2 tests of the neckline, actually 3 if you count this one here, but you got 2 subsequent tests of the neckline before moving to the downside. Now the other thing is, if I zoom out slightly, you can actually derive, I'll do this quite quickly hopefully, you can actually derive another head and shoulders top. You could say that's your left-hand shoulder, that's your big head, and your right-hand shoulder. And subsequently, you actually get a downside target that, again, was also met. So that your red line is the downside target from your double top. And then subsequently, you've got a consolidation around that target, which is interesting. And then suddenly you start to go again, and you sharply move down towards the target, the implied target of the big head and shoulders top. So a couple of patterns in one on that Euro-dollar chart there this year that you could have played. And here's a double bottom with your 1 low, 2 lows, and then breaking to the upside. And subsequently, you've got an implied target, which is, again, the projection of your neckline down to the bottom, projected higher, and you start to, and again, you've got a pullback here. You actually get a couple of pullbacks and then a move below the pullback. But in terms of your pattern on your head and shoulders, they wouldn't get aborted until a move below your right hand shoulder. This is back on head and shoulders, and on the double tops and double bottoms, you actually measure half the pattern. So this one only just held on to the target before, held on to the pattern configuration before actually hitting the target. Okay, we're going to look at continuation patterns. As I said, these come in the middle of your trends, and you get a series of, these are triangles. You've got three different sets of triangles. You've got ascending triangles, which come in uptrends. They are sort of consolidation patterns within an uptrend, and descending triangles, which occur in your downtrends, where you get a consolidation with the downtrend before the further downside move. And then you've got a third triangle, which is sort of more of a neutral triangle. It's a symmetrical triangle, which you've got no real suggestion either way which way you're going to break out. And for that reason, it's very difficult to play symmetrical triangles. And you don't often see them, to be honest, but they are quite difficult to predict in terms of the breakout. But certainly ascending and descending triangles are very much... you can analyze them quite easily. So, in your ascending triangle, wrong one. In your ascending triangle, okay, that's another base. Okay, here's your descending triangle, right? You get a move into this into the consolidation. You've got a prevailing downtrend. You then get a move around support, a consistent support, but then you get a sequence of lower highs within that consolidation. And then obviously that would suggest, all psychology would suggest that a sequence of lower highs consistently then moving down towards a basis of support puts pressure, increases the pressure on the support, and then subsequently you break that support. And you actually measure from the height of the triangle projected downwards. And that gives you, in this instance, on euro sterling, your downside target of around 80.86. That was in May this year, actually. May this year, on an hourly chart. Opposite of that, I've got, I actually struggled to find an ascending triangle, which was annoying, but I did find ultimately this one here on the S&P 500. So you sort of got a slightly uptrending sequence within a consolidation, which then broke to the upside. So once you break through that support, that resistance on the upside, so in this case 1965, once you break through that reaction high, you then start to project on the upside. And you've got a couple, I've shown here on this one, you've got a couple of targets. You've got a conservative target and a maximum target. Your conservative target is ultimately you can almost draw it in by measuring the from the sort of like the slope of the triangle, and then taking that from the breakout, or you can do it another way, which is your maximum upside target, which is your measurement of the triangle height higher from. Let's do that. Let's give a vertical line. Oh no, that's not what I wanted at all, is it? You measure the height of your triangle and project it upwards from the breakout. And that worked pretty well on S&P 500 this year. I did find a slight symmetrical triangle, and it didn't quite. This is on gold, and you can see this is from April, May this year. It's sort of got these converging trend lines. And it was, I remember calling it actually to the downside. Once you break to the downside, then you give the measurement of that. I think it works like that. Yeah, sort of measurement to the downside from the support on that. So you sort of measure it like that, which gave me that downside target of 1232. It didn't quite hit that. It sort of hit a low. What's that? 1240. So $8 away, but you still got a nice 50 odd $50 odd downside, which you would have ascertained from this big breakdown anyway. So it did work to a certain extent, but not entirely, because you didn't hit the target. But it was pretty reasonable effort nonetheless. Okay, so flag patterns. Now, flags, I really like flags. I think flags work very well on shorter term trading, because you'll often get, certainly on breakouts on forex pairs, you'll often get a sharp move to the upside and then a consolidation. And then that consolidation isn't actually something that turns into a reversal. It is just almost like a halfway house. And then you start to see a move to the upside, and that pretty much is basically what a flag is. It's a sharp move to the upside, which is sort of followed by a halfway house, and then you see the resistance breaking on the upside once more for your bull flags. And here we've got on Aussie dollar, actually arguably sort of like, I mean, that it didn't actually work out to be a triangle, sorry, a flag. But this one certainly did, where you had a sharp move to the upside, and then you had a consolidation, where you had a slight drift lower. But then that drift starts to find support again, and you get the next burst of price action to the upside. So once you start to breach that that downtrend, that minor downtrend, you start to then think this is a triangle, and then you can measure from the low. So you measure basically from the start of the move to the top of the to the flag, and then measure it. That again is a conservative breakout target. Your absolute breakout target, if you wanted to take it, which this one well, I mean, it pretty much did get there in the end. You can take it from the absolute. You can take it from either the bottom of the flag or the top of the flag there. So that one actually worked pretty well. That one actually worked very well, that I found. Opposite is a bear flag. This is Kiwi. You had this sharp move to the downside, consolidation, and then once you see the consolidation moving again, you then measure to the downside, and then again, both targets actually got hit ultimately. If you wanted to go bullish, you actually got both targets hit on this one. And again, that Kiwi dollar flag worked very well, and that was again this year. So a couple of flags that you've got on the hourly charts there that worked very well. Wedges are similar-ish to flags. They're more considered and often take longer to form, and the flagpoles are not in. I will show you. Sorry, let's get that back. In your flags, you tend to get sort of a strong move, and then a consolidation, and then another strong move. Whereas in your wedges, you get sort of like a more of a considered move to the downside. This is a bearish rising wedge, so and then you get your consolidation period, and then you start to get the breakdown once more. So once again, this move to the downside gives you your downside target, and it works pretty well actually. Sorry, on both your downside targets of your conservative and your maximum target work very well on this as well. Now, the whole concept of this, if anyone watched my Fibonacci presentation, it's a similar sort of concept of Fibonacci projections. These wedges, basically you get projection. It's basically your 100% Fibonacci projection target is your targets that you get derived from your flags and your wedges. So you get your move to the upside, you get that consolidation period where you get a slight drift lower, and then suddenly you start to see the price moving higher again, and then you get that completion of your bullish wedge. And in this instance, once more, this is on euro dollar again, actually 2 or 3 years ago, but still you got this nice move and subsequently bullish rising wedge that works very well. And that is sort of, as I said, that is a similar concept to your 100% Fibonacci projections that we did a few weeks ago. And bullish wedges, again, I do like flags and wedges. I think work very well on, as I said, on near-term charts. Right, and finally in continuation patterns, we have got our range breakouts. Now this is basically where you see two. This is okay. So think about what your range breakouts as the opposite breakout to your tops. In your double tops, you will get a trend that doesn't. So a trend that starts to break down because you've got effectively your double top is your consolidation, but that breaks to the downside. Whereas in your range trading breakout, you get the consolidation that breaks out to the upside. So it eventually becomes a continuation rather than a double top, which is a reversal to the downside. A trading range breakout is the similar sort of pattern, but breaking to the upside. And you will often, once again, get pullbacks into supports. And let's look at a couple here. Okay, so this one, as you see here, this could well have turned into a top pattern, but ultimately it broke to the upside instead of the downside. And once you break out to the upside, you measure the height of that range and project it higher. Anyway, if you look back to your... Christ, where's that chart gone? Okay, if you look back to your double tops and double bottoms, it's a similar thing. You've got your... Actually, back on this... Sorry. You've got your range effectively, but you break out to the upside in your double bottom and project the depth of that pattern. So the opposite of that is your trading range breakout to the upside. And this one worked very well. Again, worked very well. And in fact, you could arguably even use this as sort of like another, sort of like almost a flag pattern here. And I'll do this, see if it does work, because that effectively is a flag, you could argue, that then breaks out to the upside, and you get your minimum target from your flag, but also do you get your maximum? No, you don't actually. But yeah, you certainly get your minimum target if you treated that as a flag, as that consolidation as part of a flag pattern. But you can have certainly in this instance a conservative target of the range projected higher. And in this one, it sort of works again. And you subsequently get this sort of consolidation pattern, and then a breakout above that. Did you get a pullback? Yes, you did on this one. You got a pullback to that breakout. Sorry, I didn't notice that on this one. 34.13 back to there, and your absolute resistance was 34.03. So within 10 pips of that breakout support, you had your pullback, and then you suddenly started to trade higher again. So the concept of pullbacks is very common within pattern analysis. You didn't necessarily get one so much here, although you could even argue you got an intra-period, or in this instance, an intra-period pullback where you had the strong breakout, and then you actually pulled back to find support around the neckline. So yes, you actually did get this one here. If you actually looked on an intraday basis, at a lower level than an hourly chart, you would have seen a breakout, strong breakout, and then a reversal as well. So you actually would have got a very good another chance to get back in on that pullback towards that. So pretty much that's it. But what we can do now is look at live market analysis, because I know that we're all interested in that. And I'm going to start off with euro dollar. Now, the thing I like about Eurodollar is it is conforming to trend analysis very, very well. You had this downtrend on Eurodollar for the past 4 months since August that's hit this downtrend on numerous occasions. We had one last week just before Draghi sort of jawboned the euro lower on Friday, and we've had this rebound over the past few days, and it seems to be once more. What is happening this morning? Obviously, we've had the disappointing Spanish CPI data or HRCP data that's come out, and it seems as though the euro is backing away from this once again. Euro is ultimately, though, in this sort of trading band. This is on the hourly chart, in this sort of sideways trading band, and I think any sort of rally within this trading band is a chance to sell. I put on our site yesterday that 25.30, getting my numbers mixed up, 25.30, I put that as a selling opportunity, and it hit that pretty much to the pip yesterday, and it's nicely on side. The thing I like about this chart is also, to the downside anyway, is that these momentum indicators are rolling over. RSI is rolling over, so you've got this sequence of higher highs on the price, but you've broken, or you're starting to sort of break down that sequence of support on the RSI, and also the MACD lines are starting to tail over as well. Stochastics are in arguably bearish divergence as well, so I'm still expecting this to break to the downside ultimately, although at the moment you are trading sideways in this range. But I think on the daily chart, the fact that you've got this downtrend intact, I think suggests that we are going to be going lower. Okie dokie, GBP equals. Now this is interesting because we have had, I'll get on the hourly chart actually, because we've just been doing pattern analysis, and we've had a breakout, and look at that. Okay, base pattern. Again, do you really need to bother worrying about what you're going to call this base? No, not really, because you've had, effectively that is a double bottom, but it could arguably be a triple bottom, but it doesn't really matter. You've basically got a couple of lows that's sort of come back here. So 55.91 was the low on the 14th, and then you've got 55.88 on the 20th, and you had a couple, if I zoom in, a couple of attempts at 57.36. In fact, you got 3 attempts, because that one's 57.35 on my chart. Yes, a couple of days ago, and then subsequently we've had the breakout, and what we've also now seen is a pullback. So that means that this for this chart, it's very interesting, because we've had the pullback to the neckline, and we've also had the momentum indicators unwind nicely back to 40 on the RSI, towards 40 on the hourly RSI. MACD lines back towards neutral. Stochastics sort of in a position at which they can start to turn up. So the only problem I've got with this base pattern is the fact that it is counter trend, and I did say towards the beginning, counter trend charts do tend not to hit their targets on the upside before the selling pressure comes in. So that sort of leads me to be a little bit cautious about this, but certainly I think there is room. I zoom in slightly here. Okay, back on this hourly chart, you actually get an upside target of 58.80 from this chart, from this base pattern measured. You measure the depth of this chart and predict it higher, 58.80 pretty much. And on this chart here, 58.85 is currently where that downtrend comes in. So I think there is still room for cable on the upside in a bounce, but I would be a little bit cautious if, say for example, we started to trade decisively below the neckline. Probably you'd be using that reaction low around, what's that, 56.90. If you started to lose 56.90, then you'd probably start to think about maybe it breaking down. But yeah, I think it's still intact, because obviously we've had this pullback and it's still finding support around there. So we're not getting too bearish yet. But as I said, this is a counter trend move, and we need to be aware of that. Okay, fine. Okay. Now, Donnie Yen is my next one anyway, so that's lucky. Okie dokie. This is interesting. I like Donnie Yen a lot from a technical perspective. The thing that worries me is that we've had this. Okay, anyone who did Fibonacci with me a few weeks ago would know that we've had this upside projection, and having moved away from the 100%, you then target the next upside move, which is 119.07. We hit a high of 118.96, so within 11 pips of that upside projection target of 168% fib. We've now started to drift back lower, which is a little bit of a concern, because if you're going to go theoretically, then you could well pull back all the way to the 100% one again, 113.77, which is a support as well. The hourly chart is not so bearish yet. It's still sort of looking at this consolidation. I'm a little bit concerned that we've just lost 117.33 today. That is a slight concern of mine. Sorry, wrong way. But I think unless you lost the support of 115.44, which is the sort of like the latest key reaction low in effect, then you're not getting too upset. I think that the key support comes in around 117, and if you lose 117 support, then you're probably going to sort of continue to drift lower. But for the moment, I'm not getting too worked up on the downside whilst this 117 support remains intact, because that is your breakout level, your breakout support. And whilst that is intact, then this is arguably still a consolidation. So yeah, sort of near-term consolidation. It is contemplating what to do next. Over the last couple of days, it's just building a sequence of lower highs now, and you've also broken below that low of 117.33. So there is sort of a near-term drift going on Donnie Yen, but still, ultimately, I think Donnie Yen is a bull chart. I mean, you can't get away from Donnie Yen being a bull chart, because it certainly has been recently. That's annoying. Why is that not wrong way? But the only problem is that you could argue that you might get this situation that we saw in August, September, where you had this move higher, and then subsequently you got these momentum sell signals. You got the RSI breaking back below 70, MACD lines crossing over, stochastics lines crossing over and giving a confirmed sell signal, and then subsequently you got a couple of weeks of downside. What we're seeing at the moment today is the stochastics on the limit of confirming a crossover sell signal, MACD lines crossing over, and RSI just threatening to move back below 70. So we could be close to a similar sort of situation where you get that drift. And we saw a drift back from 110 ultimately back to 105, so 5 big figures. Well, 119 back to 113.77 would again be 5 big figures. So it wouldn't be beyond the realms of fantasy to imagine that happening again. But we'll see how it goes at the moment. But certainly at the moment, I'm not making that call yet. But it is something that is in the back of my mind. Okay, gold. There's just the little and not insignificant fact of the Swiss gold referendum occurring on Sunday. And I will look at DAX in a bit. Sorry, I'll just look at gold very quickly. You've got Swiss gold referendum on Sunday. So subsequently, the gold price is just moving sideways, doing absolutely nothing. Last few days, you could argue that gold has had this sort of spike lower overnight. Nothing really major, because it basically unwound completely. And you've got this sort of support you're getting in place at 175.50. My God, 1,175.50 cents. I can never do my gold levels without making a mistake. Anyway, and ultimately you've got this sequence of higher lows on gold, and I still think that gold is sort of edging higher, and now having broken above 1,180, I think it theoretically should be sort of now building further upside. I think the only reason these momentum indicators have lost momentum in recent days is because of this consolidation sideways. I wouldn't be putting too much weight on that yet, because I think the market is basically building for this referendum on Sunday, and once it happens, well, anything could happen on gold. If it goes through, then we're going to see a significantly higher gold price as a spike, shed loads of short covering, and yeah, I think we're going to see significant gains. On the flip side of that, if the vote comes through no, I think that quite a lot of this rally that we've seen recently is probably on the back of the Swiss gold referendum run up anyway, and I think we could see that being unwound. But you've also got the prospect of all these, technically speaking as well, a lot of longer term signals still are negative on gold. So, I mean, this is zooming out quite a long way now, but in my opinion, you've got this big downtrend channel on gold still, and you've also got a smaller downtrend channel depicted by this blue line as well, which just suggests that ultimately gold probably is likely, this is in the event of a no vote, I think is likely to fall again. Okay, I've had a request for DAX, so let's go to DAX. What causes patterns to form? Oh, crikey. What causes patterns to form? Well, they are, in technical analysis, you get patterns do repeat, and that is a fact of looking at price action over the years. Patterns do have a tendency to repeat, and basically they are just formed by a series of support and resistances and breaking of support and resistances and trend lines, etc. So it's like a combination of trend lines and support and resistances that do have the ability to form recognizable patterns, and that's basically it. There's not really a great deal else I can say about that, I don't think. But yeah, they do have a tendency to form as support and resistances change and move, and old support becomes new resistance, etc., etc. Okay, DAX. I've been trading DAX lately using fib estimates. Oh, cool. Oh, wow. Excellent. Oh, right. Thank you very much. I'll take that. Thank you. .GDAXI. Let's have a look at it. Now, this is one where I have to sort of hold my hand up and say that I sort of got a little bit ahead of myself. I sort of batted against the power of the bull market in the States, really, because you had this massive head and shoulders top on DAX, and certainly the bears would have started to get really excited about that. But subsequently, DAX has been, I mean, just ridiculously just blown that pattern out of the water. So on that regard, DAX has been just unreal in terms of the upside. I talked in my daily morning stuff about this sort of consolidation here that you could argue became a halfway house again, and that's what this blue line is. So you sort of see this, and that could arguably be seen as a halfway house, as sort of like as a wedge or as a flag, effectively, and that gives you an upside target. If I get my chart going properly, if I've moved certainly into new high ground, 10,255. It certainly looks at the moment at the DAX is very strong. I heard on CNBC today that that's 10 bull days in a row. Certainly looks, yeah, that's about right. Yeah, I'll accept that. It is 10 in a row. So it's very strong. 10 bull days in a row is beginning to get a little bit stretched, in my opinion. Anyone who looks at old school indicators such as the measles would know that is a plus 10 on the measles, and that is very, very rare that you see that. You've also got this RSI 75. Now, theoretically, RSI at 75 depicts a very strong momentum, but also you would argue Sorry, let me just unwind all that. You'd also argue that your RSI got 80 back then. Wow, what a strong bull run that was, before hitting resistance. So, I mean, you're also not a million miles away now. I mean, what's that? 9975. Wow. 10,050. So you're within 75 pips of your all-time high on the DAX, and you're up at 75, massively getting stretched on the upside, and you're not far off all-time high. You've had 10 up days in a row. Now, call me a buff old contrarian, but that is sort of getting to be a bit extreme in my view, and you could well see a bit of a correction. In my opinion, I'm going to show you now S&P, because I think .SPX. I've seen these markets go, and that S&P has gone just an incredible distance, I think, in a very short space of time. But the thing that concerns me is on the S&P is you've had all these big bull candles, big deep green candles, big bodies. But now since then, you've started to get a series of pretty wishy-washy candles that not massively bullish, and just a little bit okay, nothing too significant. 74 on the RSI. I mean, you're going to say that momentum is very strong, and it is strong, but at some stage you're going to have a correction on this S&P 500, and it just depends on what sort of a correction that entails, because your initial support comes in around 2040 on S&P, and then back towards 2020, which is that breakout there, 2019, but say that's 2020. So 2020 to 2040, there's 20 pips of support there. So those, I think, are 20 pips of very important support on the S&P 500. But I think at some stage we're going to have a correction on these markets. They're getting a bit ahead of themselves. And FTSE, look at these last few days, FTSE, 2 dojis in a row. Although we've had a bit of upside today, there's still just a little bit of sort of it's a fairly disappointing move in the FTSE in recent days, in spite of the fact that the DAX has been flying. FTSE's basically gone nowhere. So yeah, and just a little bit concerned. Right, okay, I had a request for oil, so I'm going to go, what should we do? CLC1. That is at NYMEX. No. What? CO? Oh, bloody hell. WTI. CLC1. What happened there? Okay, fine. Yeah. Yeah, I mean, you're going to get a massive spike, I think, in oil this afternoon. In an hour and 15 minutes, you've got the press conference from the OPEC meeting, El Badri, coming out with his press conference. Presumably, the market is positioned for no change in output, no cutting of output production, because it's fallen again overnight to a new multi-year low. And I mean, it just looks dreadful. To be honest, trading oil on technicals over the next couple of days could be very risky. Because there'll be a lot of volatility, I believe, more than likely to the downside. But I mean, if they do announce a cut in production, if it's a very small cut in production, then would that mean? I mean, what would it actually mean? Because I mean, OPEC's only 30% of the market. You'd get other countries that would be making up the shortfall. I mean, a small cut in production is what, a million barrels of oil a day. They do 30 million. I mean, how difficult would it be for the US and Russia and whoever to make up that shortfall in the oil production stake? So I don't think ultimately it might create a bit of a near-term short covering, but ultimately I don't think it would make that much of a difference. But yeah, at the moment, the market certainly looks to be positioned for further downside on oil. So yes, that is that oil. And Let's do Brent. Oh God, LCO C1, isn't it? LCO C1. Am I right? Yeah. So they're quite odd ricks on oil on Reuters. Similar picture on that is moved below the 70.76 and just looks downside. Look at this moving average, actually. 21-day moving average on Brent crude is very good. Very good indeed as an indicator. So yeah, that can be moved down to there now as your resistance. So your initial resistance just comes in at 81.60. And then 85, which is that reaction high there. But yeah, certainly it looks like the market is positioned for further weakness. I suppose that sort of leaves us open to buy, sell on rumor, buy on fact. Rebound, but at the moment certainly looks like we're positioned for further downside. And the downside, you've got to move out all the way. Sorry, this is quite tedious, but yes, you've got to move all the way out to 2010 levels, whereby you start to see sort of the next real supports coming in 71, 75, but ultimately that 68 around that sort of level seems to be the next really key support on Brent. Okay. Do you have dollar ZAR? Yeah, I don't really look at the rand much, so this is interesting. Okay, yeah, let's do that. Okay, so you've got on the rand pretty decent uptrend. Look at that. Wow, that is pretty good. So if that uptrend starts to break down, you're looking pretty negative. And you've also got this 89-day moving average, which is bang on. Wow, that is really good, actually. Interesting times there, you would say, because you've also got the basis of support around these levels. I mean, that is a big level. That is, what's that, 1084, 1085, wow. So you'd say that that is a massive support, and if, yeah, I mean, that is your big key support. So yeah, dollar rand obviously needs to hold on to that, and also needs to hold on to these key lows, because that would also then complete a double top if it breaks. Momentum indicators not really too bearish yet. I think everything is still okay for the bulls within this uptrend. That RSI is still okay. MACD line is still fairly neutral. Stochastics not great, but yeah, you're still holding on to all the bull arguments, which is this 89-day moving average, this uptrend intact since May. Wow, that's a pretty good one. And yeah, so you're okay still, and you're above that 1085 key support. So the bulls are still intact, and that would suggest that this is still just counter trend and could well be. I mean, seeing as we're forming support over the past few days around 1009, sorry, around 1090, it seems to be that looks okay still for trading, for using corrections as a buying opportunity. So if you bought around here and then probably placed a stop around that 1080 level, so 1082 is that key support. So 100 pips of, maybe 100 pips. Interesting. Yeah, that's a good chart. I like that chart. Might have to look at that a bit more than I have done. Right. Let's go one more. There's been a Euro Aussie shout. Sideways, look at that. Is that going to be a big base pattern? Is it going to be just a consolidation pattern? I mean, that is a key level, that. So I'll zoom back in. What actually is that? About 146. But it's now sort of trying to break out. It's doing this. So you'd argue that if it started to... I It's had one close above, two closes above, but that close was ultimately a doji, so that suggests a little bit of caution. I think if you started to see that, if you saw that close above 147, I think maybe you'd start to think about that to the upside. But at the moment, you're still, I think, playing more of a range trade. I think all these momentum indicators also suggest that's a range trade. RSI just consistently falling over in the mid 60s, buying around the mid 30s. So that's classic range trade at the moment. Certainly, if you saw the RSI pushing above the mid 60s towards 70, maybe that's going to be suggesting that we're going to see a breakout to the upside. But at the moment, I would be playing that as a range trade. Don't get too excited about that breaking out yet. I would want to see a close above the reaction highs of 147 and seeing the RSI sort of probably towards 70. That would suggest to me that that's breaking out. Okay, cool. I think that's sort of takes me to the end, really. Thank you very much for listening today. There is, as I've alluded to, that I do write all my morning stuff and I do analysis videos and weekly strategy reports. So if you go to our website, handtechfx.com/market-research, all my stuff's there. I hope it's pretty good. So, you can also follow me on Twitter at handtechrich. So I do tweet a lot of my stuff as well. So if you wanted to follow me there, it's all there. If I've not been able to cover any of your topics today, please just email me, marketing@handtechfx.com, and I will get back to you as soon as I can. And just to finish with a little bit about Handtech Markets, we're a UK-regulated London-based broker. We've got 100% straight-through processing execution. We have competitive spreads on our sites. Our platforms are MT4, CurrentX, and as I said, we've got free daily and weekly market reports. No, that is not correct, so don't worry about that. In terms of the registration for the Trade of the Year, we've just run that, and it was very successful. So unfortunately, you've missed out on that. And that is my disclaimer. So thank you again very much for listening. I wish you good luck in all your trading, and please contact me if you need any further assistance and guidance, and hopefully I'll speak to you next time. Thank you, guys.